countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Thursday, the 7th of October, 30 minutes to the European close. What do you need to know out of Europe this hour? Well, energy prices continue to fall after yesterday's comments from Vladimir Putin suggesting that Russia is ready to deliver more gas. The IEA saying today that Moscow can do much, much more. The UK commits to decarbonise its electricity grid by 2035. Energy regulator Ofgem, though, warning that significant energy price rises will continue. The yields dropping broadly across the Eurozone, particularly in the periphery. I'm thinking Greece, I'm thinking Italy. This, as Bloomberg reports, that the ECB is looking at a new post-PEP bond buying program. It could be selective, focusing on the periphery. We're going to hear from the governor of the Greek Central Bank. Let's talk about where we are with markets. Equities bid, you can see we're up really quite significantly, up by 1.7%. Nat gas here in the UK down by 10%, but still incredibly elevated at 247, Alex. But equity markets do seem to be the focus. The energy price coming down, the debt ceiling story stateside, all adding to the upward momentum.
Yeah, and here in the U.S., it's sort of buy everything in the equity market. You have growth and value and cyclicals all moving higher. Interestingly, energy is the underperforming sector in the S&P, still in the green, though, as those energy prices come off. But on the upside, you got everything. You got materials, you got financials, consumer discretionary, and technology stocks. Financials up by 1.5%. The FANG index that got so beat up over the last week or so up by 2.5%, despite the fact that yields are moving higher, now up 3 to 4 basis points. We haven't seen this level on a closing basis since June of this year. And just to highlight kind of the relief in the energy market, we were near $7 in the U.S. yesterday on MMBTU, and now we're lower by about 1 percentage point. So that's weighing a little bit on the energy sector, but none of this is over. Debt ceiling, not over. You have the budget resolution, not over. You have the energy crisis, not over. That's still staying. Just today, we get a little bit of a relief, Guy.
What is interesting is that yields are higher in the United States and yields are higher in the United Kingdom. In the Eurozone, they're lower. They're quite significantly lower, particularly on the periphery. The ECB apparently studying a new bond buying program that will be designed to prevent any market turmoil when emergency purchases, the PEP program, gets phased out earlier next year. It's going to be much more selective. It's going to be targeted, potentially getting rid of the capital key. Now, earlier today on Bloomberg Television, the ECB Governing Council member Yanis Stounaras from Greece addressing concerns over Eurozone stagflation.
The inflation forecasts are lower for the Eurozone than in the United States and in the UK. So it's natural that we are in a different phase of monetary policy.
Policy divergence, that's potentially what we could be seeing here, though it's going to be interesting to see what the energy crisis does to the inflation outlook going forward within the Eurozone. But let's talk about what this could all look like. Nicola Mai, PIMCO, joining us now to give us his take on this. Nicola, the ECB potentially going in a very different direction to the Fed and the Bank of England. We don't have the same labour inflation problems that we do in those two countries. Inflation looks like it could be high but more subdued. And the ECB apparently is looking for a much more targeted post-PEP QE program to continue to buy bonds on a much more focused basis. How do I want to play this? What is the right trade in the European bond market?
Yeah, I think it's very reasonable to expect a different trajectory for the ECB on the one hand and the Anglo-Saxon central banks on the other. Let's remember the European recovery comes after a deeper recession, which started, and the recovery started later. The fiscal impulse here has been much lesser. Wage inflation, as you mentioned, is actually very weak. It's been falling. It's about 1.5 to 2% based on wage bargaining. And generally speaking, the Eurozone has suffered from an inflation undershoot, which has been long-lasting. So I think the ECB will be very patient. I think asset purchases will continue well into next year. And as a result, I would say that this is positive on the whole for European risk and for European periphery. So I think BTPs, with a spread of 110 basis points over bonds, they have a relatively low spread. Compared to history, but given the support of the ECB and the recovery fund, they offer pretty interesting return potential. Now, when it comes to interest rates like bonds, I think obviously they're much lower than treasuries or even than gilts, which makes sense given what I said. I think some steepening of the curve. So I think the short rates will be anchored by the ECB, whereas the long rates in the curve could rise a little bit based on the economic recovery. So we're positioned for that.
Well, then to that point, like the ECB isn't going to want to really target bonds, right? That's not where the problem children are. That would be more BTPs or Spanish debt, for example, or Greek debt, for example. Now, I feel like we've come a long way from Christine Lagarde saying in a press conference, it's not our job to manage spreads. It feels like it is now definitely the ECB's job to manage spreads. What does that do when you're looking at peripheral debt?
Yeah, well, I think the ECB's reaction function hasn't been very clear in terms of what they're trying to achieve with the asset purchase program. But broadly speaking, I think they have two things in mind. The first one is to stabilize financing conditions, which could be seen as an average interest rate, government interest rate, but across Europe. And the other one is to manage asymmetric moves. So if Italy, for example, blows out, they want to avoid that. And I think with that in mind, obviously there are risks based on the rise in inflation and so on, but I think the ECB overall will be pretty supportive, which, as I said, should be positive for periphery. I mean, if you look at Italian debt, it's undoubtedly extremely high, but given the very low level of interest rates it's paying on the market, I think from here we should see a gradual reduction in debt, even with nominal growth being quite low in Italy on a trend basis.
Nicola, I appreciate what you're saying about the difference between the Anglo-Saxon world and what is happening within the Eurozone right now. But nevertheless, we do have an energy crisis in Europe that is likely to push up inflation for many households. We do have shortages as well that are going to impact those same households. They may be looking to their employers and saying, we need to keep up with the cost of living here. And you may actually start to see wages going up. I appreciate that that's not happening yet. But could these two crises ultimately start to deliver second-round effects that the ECB does have to pay attention to?
Yeah, I mean, I think the risk of a wage price spiral is what is on central banks' mind in terms of managing inflation expectations. I see it as relatively unlikely, pretty unlikely, especially in Europe, given a few things. I mean, first of all, bargaining power of labor now compared to the 70s is a lot lower. Secondly, the energy intensity of the economy is a lot lesser, maybe a third than it was back then. And then you have other factors that are likely to depress inflation, among which technology, for example, over and beyond the fact that inflation expectations are still pretty well anchored by the fact that central banks have earned a certain credibility. And when it comes to Europe specifically, I think the job of the ECB is even harder in terms of raising in terms of like anchoring inflation. In fact, their main concern may need to be to raise inflation expectations back to target, given the long-term undershoots, that I mentioned. And generally speaking, if you look at the pass-through of headline inflation into wages, that hasn't been that large in the past, and I think the gas crisis is meaningful. But I would say that beyond the winter, we should see a normalization in gas prices, which is what the futures market is also predicting.
When you take a look at the sort of extension or a phase 2 of a purchase program, so PEP ends, and then you get something else that maybe has some more flexibility there. Do we need to rethink the sequencing of the ECB? Would this allow them to sort of hike but then still keep a lid on rates? Like, could they engineer things like that to sort of change the trajectory?
I guess it's all open in the sense that programs change and strategies change. I would say that at the moment, the ECB said that it will keep interest rates low for long until inflation in the second half of their forecast period is above target. And it has also said that it will keep purchasing assets, so adding assets to its balance sheet until shortly before that. I don't really see a change in that. I think there is no rush to make long-term decisions about asset purchases, partly because I think an interest rate hike is far away. So I guess time will tell, but I don't think there's any need to shift that at this point.
Nicola, what are you seeing more broadly in the world of bonds at the moment? We had the Bloomberg Invest conference. We continue to have the Bloomberg Invest conference. And one of my biggest takeaways at the moment from that is that asset managers hate their bonds. They continue to be a problem for them in a fairly big way. Basically, they're looking at inflation at 4-5% in many parts of the developed world. They're looking at the yields. They're getting a pickup of 1.5%, maybe in the United States, but elsewhere it's even worse. Massively negative real rates that look like they're going to persist for quite some time. Is that the environment we now find ourselves in? Because if so, are bonds trading rather than investment instruments?
Right. Well, what I would say is that if you expect inflation to persist, at these levels for a long time, then you would obviously need to see a significant adjustment in bond yields. I mean, treasuries at 155, would not be sustainable if you think we are in a much higher inflation environment. But if you do think that the inflation spike we're having is transitory, despite obviously more persistent than we were expecting and most people were expecting, then you can put the yield in context and think it is actually a reasonable return. I mean, I think that there are many factors that are going to constrain interest rates going forward, among which demographics, inequality, and high debt levels, which prevent interest rates from rising a lot. And our view, as I said, remains that Phillips curves, i.e. the relationship between unemployment and inflation, remain pretty flat. So we would expect a normalization of inflation. The reality is that if you want to have a higher yield, you need to take more risk. But if you look at risk assets, I think according to most metrics, valuations in equities as well as risky fixed income are pretty elevated. And as a result, I think we're in an environment of lower returns, not just on bonds, but also on risk assets. And I think that's an environment that is one where bonds still have a role.
All right, Nicola, thanks a lot. I feel like we need a new phrase, like persistently transitory. Maybe that's something we need to coin here. Nicola Mai of PIMCO Europe, thank you very much. All right, coming up, one huge input of that, of course, is the energy crisis. When will the UK's gas supply problems be solved? How do we solve them? What does that look like? Simon Thorne of S&P Global Platts will be joining us next with some insight on that. This is Bloomberg.
A very fast transition to a new energy regime looks to be inflationary, as the desire to transition isn't quite in sync with the technology available to supply energy needs.
Alicia Levine, Bank of New York Mellon Wealth Management, Head of Equities and Capital Markets, talking about the inflationary impulse that we could potentially get off this green transition if we don't manage it correctly. I.e., that transition is going to come with heavy costs. We know that. That could be inflationary, but also not having the right technology in place could also mean that we have a lot of volatility and you get the kind of inflationary impulse that we're getting currently from the natural gas markets. Simon Thorne, S&P Global Platts, Global Head of Generating Fuels and Electric Power Analytics. That is quite the title, I have to say, Simon. Joins us now to talk about this. Simon, let's just talk about what's happening right now. We have seen gas prices sort of reaching for the moon over the last few days, huge daily increases because the market ultimately didn't know where supply was going to be coming from. Vladimir Putin steps onto the stage. He says, you know what, maybe we can fix this. And as a result of which prices come down very sharply. Are we done? Is the near-term price peak in, do you think, now? Do you think ultimately now the Russians have signaled that they will help, that things stabilize?
Stabilize, potentially. Fix, unlikely. Our forecasts still show that Russia has a limited ability to bring on unanticipated gas. Yes, it's going to ramp up. There's a seasonal norm impact in that ramping up. We'll see that. But even with Nord Stream 2 through November, solving the problem, though, the problem is too profound, too deep. European stocks are below 5-year averages. That lack of a buffer is always problematic. And of course, we are going into the peak demand season. A cold winter could be hugely problematic.
And clearly, this isn't going to solve itself, even if it's a warm winter. Like, this is going to be something that we're going to be struggling with. A point that President Putin made yesterday was that, hey, guys, you kind of did it to yourself because you opted for spot market versus longer-term contracts. Totally talking Russia's book, so everyone kind of locks in long-term supply on 20-year contracts, which is what the producers are going to want. We were shifting to a spot market. Do we shift back to these long-term spot markets?
It's too soon to tell, but unquestionably, you will see when you look around the world, and this isn't merely a European or a British impact, you will see that people are more exposed on the spot market side to these prices, and that is changing behavior. So certain countries are less exposed, certain countries can ride this more easily, are less likely to have to see change. Too soon to tell if that's an irreparable change. These things are a little bit swings and roundabouts. They come in cycles. There are advantages in certain market conditions. But right now, being exposed to these spot markets is difficult. And to your point, Alex, absolutely. This is set to stay. With the stocks low where they are, irrespective of a warmer or a colder winter, the high prices are here for a while.
Simon, many are arguing that this should be the catalyst to accelerate the energy transition. Kwasi Kwarteng, the UK Energy Minister, making that exact point earlier on today. Is he right?
It's complicated and it's not a short-term fix, unquestionably. Energy transition is part of this. Energy transition has removed some of the ability for us to respond to these high prices. Traditionally speaking, in the last 5 to 7 years, a reaction to high gas would be burning more coal. Our capability and willingness to do that is lower, which has meant we've had to burn more oil. That's a 10-year ago circumstance, burning oil in generation. But it has to be there to keep the lights on through this difficult period. Right now, renewables in the build up to this year are part of the reason the stocks were so low. Renewable power is not rateable. It's not predictable in the same way. And we had seasonally disappointing wind, and that is more impactful now and more impactful than it's ever been at any point in our history, which meant the burn and pull on gas was high. So it is a contributing factor. Now, ultimately, there are technological and balancing solutions that can help and will help. Hydrogen, batteries, increased transmission, but all take years and millions to build.
We had Lyle Brainerd of the Fed talk about the U.S. and that and that you need to have companies sort of stress tested for climate issues. Should utilities be stress tested for climate issues? We're seeing that a lot with banks and their exposure. Do we need to see that with utilities?
It's a question. It's such a complex, interwoven market globally, particularly gas. It's hard to know how that could be achieved, but it's a hot political topic. We'll see what the politicians decide as we go forward.
But do they have what we've seen in the UK is a fragmentation of the consumer side of the energy market. And maybe what we're learning here is that low prices and choice don't guarantee supply. Do we need to think about the regulatory structure that we currently use here in the UK and elsewhere?
There's potentially an uncomfortable truth in these markets right now, is that they aren't balancing on supply. And as I say, our forecasts don't suggest that Russia can cure that. Help, potentially, but not cure that. The uncomfortable reality of the moment is, our expectation is, without that relief on supply, that what we need to see is demand destruction or demand substitution. We've seen that in limited places. We've seen that absorbed in inflation. But that's an uncomfortable place to be in a cold winter, particularly from a humane position. But in reality, for the markets to function as we think they need to balance, we need to see high prices. And where we've seen action that lower those prices, that of course dents the very demand and the high price that we need in order to see it eroded in a more natural way.
Simon, we really appreciate it. Thanks a lot. Guy and I are super fascinated in this issue. Simon Thorne of S&P Global Platts, thank you very much. I'm going to talk much more about the energy crunch and all the disruptions in the supply chains and what it means for business with Eric Hansotia, AGCO CEO. That's coming up today at Commodities Edge, 1 p.m. in New York, 6 p.m. in London. Don't miss it. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Royal Dutch Shell says the events of a turbulent third quarter will have a significant impact on its financials. The company gave a first glimpse of what's likely to be an unpredictable set of earnings for the oil majors. There were big swings in gas and power prices. Plus, Shell says the adverse effects of Hurricane Ida in the Gulf of Mexico will end up costing $400 million. Home prices in the UK rose last month at the fastest pace in 14 years, according to Halifax. The average price of a home climbed 1.7% to $363,000. The annual rate of growth increased to 7.4%. Halifax says the healthy demand for housing is likely to persist despite some economic headwinds. And Pfizer and BioNTech have asked U.S. regulators to approve emergency use of their coronavirus vaccine for children ages 5 to 11. It's a move that could affect both family life and how schools operate. The Food and Drug Administration has promised to act quickly on the request. And that is your latest business flash. Guy, Alex?
All right, thanks so much, Ritika. Guy, I was like, yay, when I saw this headline. I'm obviously a totally biased parent. I have a 7-year-old daughter, and I will be giving her the vaccine the second that it is approved. It just feels like giving someone a little bit of a normal life and a little bit away would be so amazing and take away a little bit of risk there.
Yeah, I guess it's interesting. We had the whole debate last night around the kitchen table as we figured out whether or not we would be giving the green light to our 12-year-old to get the shot. And you go through the whole debate. It would be a Pfizer shot in the UK. It's a relatively lower dose one. And you try and kind of figure out what the relative risks are. We came down on the side. I think we probably always were going to, that he would have it. But you go through the myocarditis stuff. You try and figure out exactly what's happening. I think it's interesting that Moderna, a lot of the Scandinavian countries are withdrawing that Moderna shot for younger men because they're worried about that heart inflammation risk. And it's going to be interesting to see ultimately how many parents over here do go down the road of giving their kids, and we're only 12 up at this point, the shot.
Well, yes, and I also wonder the dynamics it's going to create within friendships now. Like, what happens if, your kid's friend isn't vaccinated? Like, what are the rules that then you have to take into effect when they're together? Like, I just feel like, particularly here in the U.S., where it's so divided and it's so contentious, I wonder how that's going to play out, particularly in schools. Will it be a school mandate to get the vaccine? I mean, it feels like it could get a little ugly on that end.
I'd be very surprised if there was a mandate. Europe doesn't seem to be going down that road of mandates because actually take-up has been quite high and very high for most of these shots. I hadn't even considered the friendship thing. I don't think most parents are kind of at that point. I think if you mix with older cohorts, that is certainly something that people are thinking about. But I'd be interested to see ultimately, because they're done, because the message seems to be that almost you're doing this for society rather than doing it for the individual child. That debate is a little bit different. It's about keeping schools open. It's about keeping the whole society safe. And I think it's a much more complicated decision as a result of that.
It's different here. It's just, it feels like it's become a different kind of thing. But you didn't get the vaccine boost in the markets. You got the stocks, but not with the overall market. Remember last November when we got Vaccine Monday? It just feels like it's a different feed-through flow now into the overall equity market.
Oh, absolutely. It's definitely, other things have taken over the narrative when it comes to what is driving markets right now, the debt ceiling, the energy story. Talking of markets, we're going to close up the European markets next. This is the picture. Big bounce here in Europe. This is Bloomberg. We're wrapping up the session here in Europe, the Thursday session, really positive. Huge bounce back, number of factors behind it. Hard to pin down exactly what exactly is driving individual assets. But broadly, the market feels like it's being driven macro, i.e. top down. So it's energy, looks like that's getting better. The debt ceiling in the States, that's getting better. All of these stories are being kicked down the road. But for the time being, the market's breathing a sigh of relief, as you can see. European markets up really quite strongly. Russia, as you can see, up really quite strongly as well. But nevertheless, a positive performance being driven. The FTSE's up by 1.26%. The DAX is up by 1.8%. Let's show you what's happening with the session. The Stock 600 looks a little bit like this from the get-go. We've been on an upward trajectory. It's been slow. It's been incremental, but it takes us up 1.61%. We're still sub 460 here. Remember, we were 475 not that long ago, so we're still significantly off the top, but nevertheless climbing back today. It's been an incredibly topsy-turvy week in terms of the price action. One day up, one day down. Row. This is what we used to talk about during the financial crisis here in Europe. Risk on, risk off, risk on, risk off. Seems to have been the story this week. Let's take a look at what is happening with some of the other assets we're watching. I mentioned the fact that the energy story seems to be easing up. UK natural gas down by 10% today. Huge moves. the moves on the upside were bigger, but obviously then you're dealing with bigger numbers, so the move on the downside for a smaller percentage move. 244 is now where we're trading. Brent crude actually bouncing back. They're not going to release supplies from the strategic reserve stateside. That's given Brent a bit of a boost. And we're getting, what is it, a 4 basis point move to the downside on BTPs. Brilliant Bloomberg story, brilliant Bloomberg reporting on the fact that it looks like the ECB is going to have a much more targeted post-PEP program to buy European bonds. That probably focuses on Italy, BTPs, and the Greek bond market, the peripheral bond market, really getting a boost off the back of that. Let's take a look at some individual names. I just want to focus on what is happening. DHL, Deutsche Post is the name you need to think about here, talking about a really significant pickup in its free cash flow. That is certainly a story that we're watching. You can't see it, but I promise you that Deutsche Post is on the move today. Also, IAG and Centrica. IAG up, looks like they're going to be going for a low-cost airline based at Gatwick Airport. Kind of takes us back to the Go days, which ultimately got rolled into EasyJet, remember. And then there's Centrica, which is also a focus today. Some really interesting notes being published on what is happening with Centrica right now. I think there's an upgrade today. I think it was Bank of America out with the upgrade today. The stock's up 2.26%. What you're seeing is a number of the smaller energy providers here in the UK failing. We were hearing from Kwasi Kwarteng a little bit earlier on, Alex, that there is an expectation that potentially we could be seeing more of these failing. And that consolidates the market and puts potentially some upside into Centrica.
Yeah, let's get to that. Look at more to Centrica. Joining us now is Patricio Alvarez, a Bloomberg Intelligence analyst for energy and utilities, joins us. Hey, Patricio, do you see that some of the utilities, it'll be good for them? You can have more consolidation and make the market overall stronger?
Yeah. Yes. So certainly what we're seeing in the market right now is this sort of consolidation that Guy was speaking about. We see that continuing whilst the power prices remain elevated. And this could be this could have a silver lining for other utilities. Perhaps Centrica is the most interesting story today. Centrica is poised to benefit from the stranded customers left behind by failing suppliers. And whilst these accounts will not be profitable in the near term because they have to take on the added cost of those wholesale customers, in the long term, we see them being able to absorb the losses because they have these increased customer bases, and also they're better hedged into the future. And probably we'll see tariff hikes gradually coming over the next 6 months or so in Europe.
Patricio, can I just say, excellent work getting on set quite so quickly. There was a bit of a set change there that he managed perfectly. First time on Bloomberg television, so greatly appreciated. In terms of the structure that we're seeing here in the UK, are we going to see changes? Do you think the current system is being shown to be incomplete? Because we didn't stress test the smaller players. We didn't know whether or not they could handle a significant rise in the spot price. We're now learning they can't.
Yes, so that's a very interesting story that we'll see over the next several months. As I mentioned before, we still expect a number of suppliers to be threatened by this crisis. So we do expect to see some sort of regulatory response in the midterm. This is a trend that has been going on for the past 5 or 6 years, where smaller retailers have been undercutting the larger utilities, which are more structurally hedged and have this ability to actually, afford the really perfect hedges in energy. So we do see maybe some pressure for a regulatory shift.
Do you think that we're going to have utilities be stress tested in the same way that banks are? Could they handle it?
That you make a really good argument there, Alex. I think for the size of utilities, I think utilities that are larger are structurally more regulated than the smaller players. So in a sense, they are already facing that sort of challenge. Similar requirements, similar structures, and heavily regulated. It's just the smaller suppliers which are more in depth into the wholesale markets. That makes sense.
We know that now that we can figure out a way of making small failures work, i.e. the bigger companies absorb the smaller companies' customers. And ultimately, as you say, while not initially profitable, they will be profitable further down the road because you're just getting this consolidation process. Could the market handle a failure of a bigger company?
That's a key question, but we don't see that happening.
Right.
As there will always be mitigation factors. There will always be other players that would be in place to take on the customers. We do believe there's enough power supply, enough power generation. The infrastructure is there. It's just a matter of who's ready to take on and operate it, and we do see some space for that. Although any failures in a big sense would be highly unlikely, I'd say.
Patricio, great stuff. Thank you for coming for the first time on Bloomberg Television and doing so in such a swift way. Thank you very much. Patricio Alvarez of Bloomberg Intelligence. OK, we're going to wrap the markets up. Let's take a quick look where European stocks have settled. Every sector in positive territory. The DAX outperforming, up by 0.8%. But I think a resolution to the short-term problems we're facing in the energy market and with the US debt ceiling, Alex, certainly providing a nice little pop today. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, US Senate Majority Whip Dick Durbin. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Senate leaders have agreed on a deal that averts a default on U.S. government debt. For now, the plan extends the debt ceiling until December, when lawmakers will face another vote to raise it. Senate Majority Leader Chuck Schumer says the hope is to get the agreement passed today. Apple has a new plan for cars. Bloomberg's learned it's working on technology that would allow drivers to use iPhones to control the air conditioning, seats, and radio, amongst other functions. Apple's CarPlay interface is already used by millions of motorists to control music, get directions, and make phone calls. CarPlay is offered by most major automakers. A magnitude 6.1 earthquake struck near Tokyo today, rattling parts of the capital, the most since March 2011. Officials say the quake caused buildings to sway and hanging objects such as signs to swing violently. Some injuries have been reported. Train and air services were disrupted and power was knocked out in some areas. There's a booming market for finance jobs in London. Now that the UK lockdown has been eased, there were more than 8,300 new listings for financial services positions between July and September. That's more than twice the number in the third quarter last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex?
All right, thanks so much, Ritika. Guy, you and I were talking about this on radio yesterday, because at the same time you have Cathie Wood's ARK Innovation is going to be going to St. Petersburg, Florida, out of New York City, closing their offices. And we were talking about how the financial drain and how they're leaving in different locations and how you get them back. What would need to happen to do that?
Well, I guess London is facing a number of different problems, one of which is pandemic related, the other one is Brexit related. A lot of people that used to work here, that had EU passports, it's much harder. And the opportunities and the pay are certainly going up in places like Paris really quite significantly, making the move or staying at home much more easy. And as a result of which, we're potentially left with a deficit. It feels like it's true in so many industries right now. I don't see why finance should be an exception. London as a financial centre is not certainly going to disappear. Huge demand for jobs. Does it lead to more productivity? We'll wait and see.
So for you guys, it's more of it's a COVID, same for us, COVID, and Brexit. For us, it's taxes. So it's the state and local tax deduction, which brings us back to where we are with the infrastructure bill, and if that's going to be a part of it. And if you alleviate that or bring it back or raise the cap, then you can deduct more of your state and local taxes on property, for example. Does that make a difference? And can you get more people to stay? I think that's also another question. It might be too late.
Can't fix the weather, though. It's much nicer down there.
But do you want to live in humidity? Do you know what humidity is?
I'm trying to wind Alex up. Alex is such a committed New Yorker. Kind of born and bred. I'm kind of just trying to poke her a little bit to try and get her to rise a little bit. The weather's terrible. No, look, seriously, what I do hear, though, is that crime, what is happening in New York at the moment, makes it a much tougher place to live. And as a result of which, people maybe along with the weather and the taxes, are making a decision based on that. And as we discussed there, Wall Street is, as we get into the digital world, not a place, it's a concept.
So staying with Wall Street for a second. This is a great story by Shali Bassick, and I think that everyone should go on the terminal and read it. So basically, women in finance are using online poker to help their careers. There's a Poker Power. It's what it's called, and it's a dozen courses, and it's created by a longtime trader, and it's teaching women how to take risks, how to negotiate, how to play poker, and then how to be better at your finance job. I love this story. There's nothing I don't love about this story. I think it's great, and it should come to Bloomberg.
What I think is interesting is that, yeah, that's true. I'm always up for a game of poker, but maybe I don't get invited. But what I think is interesting is that there's a lot of research, and the point Shani makes his points is that women are just as good at negotiating, but the reaction to them negotiating is different. And that, I think, is where the problem lies.
But also, I think that the risk-taking scenario as well, not that women don't take risks, but on the whole, learning how to take them in a little bit of a different way, to your point also, that they may be, the reception may be a little bit different. That would be huge. That would be a lot of fun. What's your poker game of choice?
Texas Hold'em.
Of course.
I used to play with my brother's friends who kind of were all really good at maths, and playing with them is a completely different ballgame.
Right, but we can do good acting, so there's that too. Same.
Yeah, that's true.
Texas
Maybe we
Hold'em
have
is
a
good.
better poker face. But yeah, basically, ultimately, it's about reading the person opposite you and figuring out the odds.
We can get that.
Okay, what are we going to do next?
We're
going to talk about my tease, Tesla, holding its annual general meeting. It's holding it in Texas, which is interesting as much as anything else. We've also got news on Apple today on the car as well. Dan Ives of Wedbush Securities, he's going to be joining us next. This is Bloomberg. From London, I'm Guy Johnson. Alex Steele is very much over in New York. This is the European Close on Bloomberg Markets. Let's talk cars. Tesla is holding its annual meeting. It's going to happen a little later today. It's happening in Texas, which is interesting. The electric car company's Q3 numbers beating the highest analyst estimate despite the ongoing chip shortage. For more on what we can expect from Tesla today and the significance of them being in Texas and holding the day there, are they going to move there? Is the headquarters going to go there? David Welsh, Bloomberg Detroit Bureau Chief. David, what can we expect today? What should we be looking for?
So one of the big issues here are there's a shareholder proposal to oust two members of the board, one being James Murdoch of the Murdoch Media Company fame, and then Kimball Musk, Elon's brother. Shareholders just want more accountability. They want more disclosure from the company, particularly when it comes to hiring and diversity. Tesla recently had to settle a lawsuit related to that. There's another motion based on that. But the board has been an issue with Tesla really for a very long time. Investors have thought whenever there were down periods for Tesla or whenever Elon was maybe in a bit of trouble with the SEC, that there just wasn't enough outside oversight. And they did make changes to the board, and they've got sort of more independent oversight, but you still have Elon's brother Kimball on the board. Murdoch has not been a popular director with some, so you've got a proposal to get them out. And then, there's this other issue with the lawsuit where they had to settle $137 million over some diversity employment claims. And that's another issue where shareholders want a little more clarity, because you are seeing more actions like this against companies, Activision being another one lately, and shareholders are just worried about how companies are managing all of this.
Anything that we're going to see here today that's going to be a catalyst again for the stock?
There are a lot of things that Tesla's working on technologically, and often, AGM's not the best place for that, but you never know with Elon Musk. He might just throw something out there. They are supposed to debut the latest driver assist technology on Friday. There could be some chatter about that. They've got new vehicles coming, and Elon likes to talk about that stuff. So that could always help things out. They're on track to sell 1 million vehicles, so maybe he gives an update on whether or not they're going to hit that mark. The company had a very good third quarter in sales. That could be a catalyst if he talks at all about sales momentum, and they've had great sales momentum. So if maybe he wants to distract from some of these other, let's call them governance issues, then maybe he could throw something like that out there, and it could be a catalyst.
All right, good stuff. David, thanks a lot. We really appreciate it. Bloomberg's David Welch joining us. For more on what to expect from Tesla, I want to bring in Dan Ives, Wedbush Securities Managing Director and Senior Equity Research Analyst. He has an outperform rating on Tesla and a $1,000 price target. You're in a car. It's not a Tesla, right? You're coming back from the GM AGM?
Yeah, I'm at the GM Analyst Day where they've really talked about the transformation on EVs happening with Mary Barra leading the charge. But this is a big day, not just GM, but with the Tesla shareholder meeting as part of this green tidal wave.
Tesla had the market to itself for a while, Dan. Not completely to itself, but it's now looking increasingly crowded. Why does Tesla still deserve the premium?
Well, I've never viewed Tesla as an automobile company. I've always viewed them as a disruptive technology player. And I think when you look at the overall $5 trillion market opportunity in EVs, Tesla is going to continue to lead that charge. And the big focus today is going to be about capacity improvements. Of course, Austin, not coincidentally, that they're hosting the shareholder meeting there. That and Berlin are sort of the 1-2 punch to really expand capacity going into next year. And we're just continuing to see this green tidal wave play out. What Tesla did in 3Q with their back against the wall and the chip shortage is just continues to be another feather in the cap for the bulls.
Hey, so what gets us to your $1,000 price target? What's going to be that catalyst?
Well, I think that catalyst is going to be going into Q4 and into next year. I think we could be looking at close to 900,000 units. And then more and more you start to go into next year, we could be looking at 1.3, 1.4 million units. And the chip shortage has been overhang, not just on Tesla, but the overall EV market. I think that starts to clear going into later this year, early next year. And I think this is something where investors continue to underappreciate the market. And I think specifically with Tesla, still in the early innings of what I view as just this green tidal wave playing out.
Dan, if Tesla's not a car company, then I guess you could probably think about it as a software company. Certainly that seems to be where a lot of the value may reside. Apple, now looking like it's basically trying to crank up its software that it has in cars right now, maybe rolling that out to become something a little bit more at the moment. I get into my car, the Apple system sort of handles a lot of what I'm dealing with in terms of navigation and entertainment, but it's not into the AC, it's not into the speedometer, it's not into a lot of the kind of core components of the car. Apple wants to go in that direction. If Apple does that and it goes there, how does that change the game for the wider sector?
Well, I think first off, 2024, we believe Apple comes out with the Apple car through a partnership, strategic partnership with the likes most likely of VW. And this is just a drum roll to what I view as Apple, the next step of innovation. And they're not going to look at this green tidal wave from the outside looking in. If you look at autonomous and a lot of the technology they developed in Cupertino, I think this is going to be really the next stage of innovation for Apple. And what we're really seeing here, when you take a step back, it's technology and automotive merging. You're really seeing a convergence of that. And that's something that we expect to see with Apple going further and further into next year, and 2024 really being the year where I see it getting rolled out.
So, Dan, where does that leave Tesla then in relation to Apple?
Well, Tesla's going to continue to be on the top of the mountain in this EV race. It's an arms race going on. Look at the likes of what GM, Ford do. And I think GM's rolled out a massive amount of models coming out over the next, call it 4 or 5 years, that could transform GM. But this is a green tidal wave. It's only 2% of automotive sold are EVs today in the U.S. That's the opportunity going forward. Going to be many winners in this, shift to EVs.
Dan, I look at what is happening here in Europe. I look at what's happening in the States. I look at the energy crisis that we're experiencing, making sure that we have enough supply and storage critically for what we're doing. Do you think car companies are increasingly going to be perceived as the solution there? I noticed that the new Ford F-150, you can power your house for 3 days off it. How big a selling point is that going to be, and who do you think is going to be best there? Because I have to say, if I was looking at a car and trying to figure out whether or not actually it had some redundancy for my wider life, that would be fantastic.
Well, I think it's really starting to happen among automotive. I think what you're seeing, GM roll out, Ford, and a lot of these other EV players, I think they're going to start to be viewed more and more, not just as a car company, but from power supply and what you're seeing. And there's a shift. You start to see what we're seeing in Europe. You start to look at oil prices overall. That's just more and more of an acceleration toward EVs. And automakers more and more are going to control their ecosystem. That's why it's a renaissance going on in the automotive sector.
What kind of car is that, Dan?
I'm in an Escalade right now coming out of the GM Analyst Day. And, if you look what they're, I think the Hummer is coming around the corner, and I think that's a special vehicle on the EV.
Great stuff. Dan, thanks very much indeed. Get out of the way when it comes around the corner. Dan Ives
Thank
of
you.
Wedbush Securities. Greatly appreciated. Alex, what have we got coming up in the next 24 hours? We've just been talking about the Tesla meeting. You got President Biden, but it's payrolls tomorrow, isn't it?
Yep. And tomorrow, U.S. payrolls, like you just said. It's going to be huge. It's going to be interesting. We also get wholesale inventories. That's going to be a lot of fun as well.
I think VW is holding an ESG day as well. That's going to be something to pay attention to. Jane Harmon, the Wilson Center Distinguished Fellow, joining Balance of Power, and David Weston. Alex and I are going to radio. This is Bloomberg.